This is just a brief intro about me. I did as a IT entrepreneur that postchat.com, which is a very complex and not usable. Of course, there's a lot of data there, but at first glance, you can't use it. That's where we failed. And then my day job is I work as a trader in an offshore hedge fund or whatever you can call it as. The Stingray Capital is basically the Stingray is the tribute to the Australian guy, the crocodile guy, Steve Irwine. And the whole flow of this presentation would be not in order because you can't make an order of it, like A, B, C, D, E or whatever. It will be a little disjointed, so you have to connect the dots at the end of it, like 2 to 3 hours it takes. And unlike other professions like medicine, engineering, or anything, especially in this financial field, there is no right answer. Like in medicine, yes, you have to do the exact way as mentioned in the textbooks, any surgeon or operation. Otherwise, you will be dead. I mean, the patient will be dead if you deviate from anywhere. Same thing with your engineering. You have to construct a house exactly in the same fashion as described in the textbook. Otherwise, it will collapse. Either you put less cement or your base is not proper or whatever. Unlike any other professions, there is no right answer in financial field. Just not even an approximate answer. It's just a risk. Like if I say like, oh, you get about 8% returns on average. Obviously, you won't get 8% returns every year because it's average. Some years you get minus 20%. Some years you get plus 50%. So they will be all over the place. In which case I'll be wrong because I said like 8% average returns, right? I think you have access to some of these books. So this is just a time pass activity that I do when I have a lot of time or something to deviate my mind from. The economics here doesn't work. Don't think people make a lot of money in writing these books. Unless otherwise you market or you title it in a clickbait way. Something like how I made $1 million or $10 million or how to earn 100% in a year. Those kind of books might sell. But otherwise, this is a very specific and niche field. You probably, if you sell 1,000 copies, actually you can consider yourself as a star. And if you go via publisher, you get about 10 or 15% royalty. 10% for the lesser mortals and 15% for people like J.K. Rowling or Chetan Bhagat. Then you can calculate the economics. So it is simply not worth if you're writing the book for money. Maybe you can write it for fame or to get connections across the world or wherever, whoever is in this field. And the standard disclaimer, right? So it's not an investment advice, so things like that. And I would like this to be interactive. Whenever I put a slide, if there's a question mark, just do a guesswork. So you will know what is the right answer or wrong answer. I will distribute these slides after the end of the course, probably by the end of the day or whenever. So the question is, what are the typical investment avenues?
Equities and bonds.
equities, bonds are the biggest and also alternative.
And then you also have real estate, which is,
real estate.
and you also have gold, which is Indians' passion or whatever.
Now the Bitcoin, digital gold.
Sorry?
Digital gold, would that also be considered an asset class?
It's just a replacement of gold. That's it. Instead of having a physical gold, somebody is giving you a paper. That is what.
This cryptocurrency thing, would that also be considered?
That's a recent asset. I wouldn't. I mean, because I don't have history, I didn't put. And moreover, the slide is copied from somewhere else. Yeah, I mean, you can always consider crypto also as an asset. Right now, barring the legalities and regulations, yes, people have made a lot of money. So it's an asset class, but it doesn't have much history. So I don't have the data. So that's the reason I didn't consider, I didn't put that as an asset. Otherwise, yeah, yes, you can also consider that as an asset. So now this particular slide just talks about equities and bonds from 19,000, like 1 century data across all the countries. Italy, Belgium, Germany, France, Spain, Portugal, and all over the place. I think all the top G20 countries are listed there. And the first sentence or the first word, which is called real. What do you mean by real returns?
Minus the inflation.
Yes, minus the inflation. So you might get 20% returns, and if inflation is 10%, your real returns are only 10%. So this is about the real returns over the last century. The equities are somewhere around about 4% on average in across all the countries. The first 2-3 countries are bad because they were involved in the war, Italy and Germany. And AUT, I think, is Austria. Towards the bottom, towards the right, I don't know how do you explain higher returns than other countries. The Australia and JAF is South Africa and USA. How do you explain higher returns than other countries?
I think because of growth.
Mostly Australia and South Africa, or I don't know about South Africa, but Australia is called.
Most of these countries, my view, have a lot of other resources as well.
Resources, and it's a lucky country.
Yeah, that reflects in the
South Africa.
equity return.
And the USA is higher returns because of innovation and whatever you could call dollar exporting or things like that. And other countries are basically at 4% average. So that's what you get in the stocks. And bonds do have a little bit of edge of about 2%. Right? I mean, the average is about 2%, somewhere like 2% or 1%. And this is what your couple of assets. Bills is nothing but cash. It's like an overnight rate. Now this particular thing is the slide is copied from this particular book. It's called Credit Suisse Investment Returns Yearbook, and you should make a practice of reading this book, download and read it in your free time. There are about 10 or 15 yearbooks. You just search the year, you get it. Like I want it for 18. Download, and it's a good read, and moreover it's a free, and it has a lot of data and some perspective. Whatever the perspective the authors might have said may not suit your thinking, but still read it. Like if they say in one of the editions, go for equities. Now equities are falling in this year. You can't blame them, but that's their opinion. But yeah, it has a lot of data. So this is where the yearbook is about. And in each year, they take a specific theme. I don't know what the 2018 theme is. Let me just read it. It's a factor investing, which is what actually we are doing in this course, in this seminar. And if you look at 2022, which is the latest, this focus on inflation, that's what the heading says, right? And interest rates and diversification. Where is this book? Yeah, the point is download each year's copy. I think they go back all the way to maybe 2010 or 11. I don't remember, but download each book. Take a printout if you are an offline reader, and read it. So you get some small hint, whatever it is. Somewhere he would have given this particular slide, what I've used. The same thing is what I copied from. So that's the source. Yeah, you can pick up, read it, and get this the one. Yeah, but this is a different data, but somewhere close to it. No, that's fine. So now read it leisurely. And then the next question is, what is risk? What is risk in financial world?
In financial world, risk is always risk of losing the money, either in terms of capital or um, equity or debt or whatever it is. Risk is if you have put some money, if you lose, or what is the probability of losing, that is the risk that is associated with that investment.
Yeah, that's correct. So risk is nothing but loss of capital. Like I started with 100 rupees and today it's not 100 rupees anymore for whatever the reasons. So that is the risk. There's no way you can avoid it. The only thing is you can reduce it. There's nothing called zero risk or minimal risk. Yes, you have to take a risk and you need to know how much risk you are taking in quantified terms. Now, how do you avoid it? How do you avoid the risk?
By diversifying.
No, you can't avoid. You can
Reduce
only-
the risk, not avoid.
You can't avoid, you can reduce.
Can only
So the way you can reduce the risk is, if one thing doesn't work, maybe other thing works. Okay, if stocks are going down, maybe bonds go up. So that's neutralize your loss in equities or reduce the loss in equities. Or if both stocks and bonds are going down, maybe gold can go up. Or maybe right now the story is inflation. Okay, inflation related story stocks or inflation related story assets might go up. The inflation related assets are, what are inflation related assets? What are the assets that can go up in an inflation environment?
Commodities.
Tips.
Commodities, yes or no, because yeah, in the initial phase they go up, but now once the producers realize we are making a lot of money, they do a mistake of creating oversupply in terms of either expanding the plant or whatever, and eventually the demand will cool off. So the prices will come down, the commodities. I wouldn't, maybe yes, but I wouldn't really bet on commodities as an inflation thing.
Any asset class which has
The only thing I would put is real estate. Because the cost is going up, your housing will obviously goes up, the price, either the rental or whatever. So that would be a theoretically and historically a good bet. Hold real estate if your assumption of inflation going up is correct. Commodities so and so, but I wouldn't bet my house on that. So if you have like 4 portfolios now, in the inflation everything goes down. Probably real estate might be holding up or might be going up. So you will balance it out. So that's why you make a diversified assets. Now, when it comes to only stocks, you need to have a diversified portfolio, number of stocks. Unlike Warren Buffett, who preaches concentration, or he makes fun if you don't know what the company is doing. Yes, obviously I don't know what the company is doing. Neither I'm close to company founders or company management. So there's no way I will know what the company is up to. So I wouldn't buy into that theory of Warren Buffett. So now academic literature says as you increase the holdings, your risk will come down. And what is that number? People say somewhere around 50 or 100. That's where your risk will come down, rather than holding just 5 or 10 stocks. You can read in this particular reference. And there might be a few other academic literature like this. The point is, yes, you need to have at least 50 stocks to reduce the risk. And now we are talking about picking up the stocks. Yes, we can pick 10 stocks, 20 stocks, 50 stocks, or whatever. The next question is, how many stock pickers beat the respective benchmarks? How many you think? This is your famous movie dialogue, right? Maybe. You can actually search on the internet. This is called SPIVA report. And whichever country you are from, you can do that. So this is the latest report. SPIVA 2021 year end. I don't know when was this published. End of 2021. Maybe not December, they would take some time, maybe Jan or Feb or sometime. This is the story. Index has returned 10.5% in the second half of 2021. These are the funds, mutual funds. Percentage of funds outperformed by index. That's in the last 6 months is 54. That means 45 funds have bet the benchmark in the large cap category. Now, if you
Is this record inclusive of their fees or exclusive of their fees?
you have to read the fine print. Maybe inclusive or maybe exclusive. I don't know. You have to read the fine print of this article. But it doesn't matter whether. Of course, it matters because some of these guys charge 1%, 1.5%.
It's inclusive of fees,
Gaurav. Where is it written?
It's not written in the thing. I had attended one of the conferences 6 months ago. It's inclusive of the fees in terms of when they do the calculations.
Yeah, that's fine. Then it's good. At least it's a realistic report. You don't need to search for their expense fees or whatever. Now, this is just a 6-month story. Now, if you go back for a larger data, like over 5 years or over 10 years, that picture will be very bleak. For an example, you have all the data of the mutual funds in here. I want to screen the mutual funds. Where is the link? Yeah, this one. There are a lot of categories: open-ended, closed-ended, and equity, debt, hybrid, which is basically equity plus debt. Solution, I don't know what it is. You can just check. I'm restricting this particular query to only equities. And what is the style? It could be large cap, value, blah, blah. So I'll restrict it to large cap. And go give me the entire data, whatever you have. this one. The benchmark is for this, all the mutual funds. How many of them are there? 36. Benchmark is Nifty 100 or S&P BSE 100 index. Now, you have two things. One is regular and one is direct. What do you mean by regular and what do you mean by direct?
Direct doesn't have any advisory fee, in the sense that the investment made by the investor is directly with the mutual fund.
Every pie goes into the mutual fund.
Yeah, the other category, there is a portion which goes to the advisor, who actually puts in his code and processes that investment initially. So they have
only
a
portion of it, or whatever you call it, the mutual fund distributor commission. So if 100 rupees in the direct goes 100 rupees into the mutual fund for investment. Your 100 rupees in regular will be 1 rupees taken off, or half rupee, whatever is the commission. So the rest, which is 99 rupees, goes to mutual fund. So do not even bother looking at regular, or do not even bother looking at regular options investing, because you are making somebody else rich, probably your distributor. Go for regular, unless otherwise it's your brother or it's your mother who is selling you, because the money at least stays in the family, but not for some outsider. I wouldn't give free money just like that for mutual and fund distributor. It was a practice earlier, but now it's regularized. So always look for direct. Now I'm not interested in 1, 3 or 5. Let's go to 10 years. This is 10 years regular and 10 years direct. And this is the benchmark. Out of 36 guys, because there was no practice of direct that time, we have to settle for regular. And this is benchmark, right? So what I'll do is, let me insert a column here. If is, because if the fund is not 10-year-old, you will get a blank like this. So I want to manage that blank via a formula. So is it a number? Yeah, if it is a number, then calculate the difference. Otherwise, don't. This is the benchmark return minus this. Else, put some hyphen. Now we had 36. Now, how many of them are there? So it has come down to 26. So 10 guys don't have the history. And how many guys have outperformed? That means they should have given you a positive excess returns. Uh, 19 guys have given positive returns. That means 7 guys underperformed. And 19 guys have given you positive returns. Out of which, let's say, what is the biggest outperformance? It's about 4%. Now, if you look at more than 2, how many guys have given? 5 guys. So out of 36 funds which are existing as of today, there were only 26 guys who have more than 10 years history. And out of which only 19 guys have outperformed the benchmark by a small margin. The few guys who have done more than 2% of outperformance are only 5 funds. What is their AUM? Did they beat with decent money? No. The Taurus large cap fund, they have done it only with 30 crores. And the biggest guy is IDFC, which is at least a sizable assets under management, 1,000 crores. That is as of today. I don't know what it was 10 years ago. And he has done it good with 1,000 crore base as of today. He is beaten the benchmark by about 2%. I would include maybe this also, because this also is done on a big sizable base. So only these 2 funds are the ones you should be considering. Now,
So these would be after that management charges and stuff like that, right? Or
yeah, that's what other guy said. No, I don't know who is that. Parikshit or who mentioned that?
Oh, this is the MP website, right? So MP website also, that was the other SPIVA, right? SPIVA includes, but
okay, I don't know this one whether it includes. Okay, that's a SPO. So you have to read the fine print. Whether it includes.
Value research also includes inclusive of the expenses.
I don't think value research does any of their proprietary research. This is from here only. All the data is provided by the industry, which is from AMFI.
So, if since we are taking the what do you call it, is this regular only, right? All the data.
I have taken regular because there was no direct 10 years back.
It only started on 2013.
Yeah, there was no concept of direct at that time. You have to go regular only. The direct concept is only very recently done by SEBI. Right. So now this is the 10 years story of these 2 funds. Now, if you come to 5 years, this is the direct, right? And benchmark is 13. So he is underperforming the last 5 years. Much of his outperformance has come in the start, or at least in the first 5 years rather than the recent 5 years. Now, again, if you go and look at 3 years, the story is the same. So this is direct and this is benchmark. So he's underperforming by 1% now. 3 years. Okay, that is 3 years story. 12 versus 14. 13 versus 13.5 versus 14.5. Now in the last 1 year, direct and benchmark is grossly underperforming, right? 8 versus 13 and 11 versus 14. So even if you had picked up these 2 guys thinking they have done extremely good in the last 10 years, but in the last 5 years, their story has changed. So now I would remove these two funds also from my investment thesis, right? Because I want a consistent performance in all the four category. I mean, all the four rolling returns, 1 year rolling returns, 3 years returns, 5 years returns, 10 years returns. I want the fund to be outperforming the benchmark. At least 3 out of 4. Maybe one they can miss, either 1 year or 3 years or 5 years, but not all, right? Do you agree?
Yes.
So in which case, what's your conclusion now? Now we have all the data from AMFI, 36 funds. Which fund you will select? So this is 26. 36 got filtered to 26. Out of 26, only 19 are outperforming. And that outperformance, if we put more than 2%, it has come to 4, right?
Yeah.
Total MF 36. Then 10 years history is only 26. And outperformance is only 19. And out of which greater than 2% outperformers, only 4. And are the 4 guys doing it on a are those 4 doing on a bigger scale, bigger AUM? Maybe yes, maybe no. And how many of them have consistently in terms of 1 and 3 and 5 and 10 rolling returns? What is the answer to the final question?
0.
0, right?
Yeah.
You can do this analysis for across the board and select. I wouldn't be so harsh on all of them. At least maybe 3 out of 4. 3 out of 4. Not all 4 out of 4. Maybe 3 out of 4. Do it across all the categories and let me know any fund. Do across all these categories like the same way that I have done. And yeah, if you find any fund, you let me know. I would like to invest even if he's charging 1%. Now you have both the SPIVA and both AMFI data. So what's your conclusion to this question?
Very few.
Not very few, 0 or maybe 1 or 2.
Yeah.
And it's very difficult to pick that particular one because considering the fact that there will be at least I don't know how many mutual fund houses are there in India, maybe 40 or maybe 20. And each mutual fund will be having at least 10 to 20 schemes. So that will give you a choice of about 300, 400 mutual funds. Out of the 300, 400, pinpointing that 1 and 2 is very, very difficult. And the answer is 0. 0 or maybe few, like whatever you were saying, right? Maybe 2 or 3. Now with this, the whole story, what is the conclusion now?
The long-term index beats everything actually.
It's a bit futile to find that star performer. star mutual fund for more. So if you can't beat the benchmark, at least join, right? Is this a reasonable good
Yeah.
assumption to make?
Yeah.
All right, so just give me 2 minutes break and I'll rejoin.